They say that April showers brings May flowers, or it may be that April showers brings more May showers. And so predicting the markets is kind of like predicting the weather. And in my 25 plus years working as a financial advisor, we found that people make lots of predictions, and some of these predictions are good and you can stand by them. Some of these predictions aren't so good. This time of year, lots of people think about selling in May and going away. And we'll get a little bit into that. We'll get into some calendar effects things and some ghosts in the machine things. The ghosts in the machine are these little things that pop up that these hedge funds pick up on, like Jim Simmons from Renaissance Technologies or D.E. Shaw. They've noticed these things. They use lots of extensive math to figure all this out. And for average investors, it may be a little harder to figure out all the ghosts in the machines. But we can take advantage of things like the first law of motion. Newton came up with the first law of motion many hundreds of years ago, and he says that an object in motion tends to stay in motion unless acted on by an outside force, and these things happen with the markets as well. Something in motion tends to stay in motion unless acted on by an outside force. So a trend is your friend. So we want to follow trends. We want to look at what's going to continue. The January effect points to this. If the market's up in January, it tends to stay up throughout the rest of the year. The sell in May and go away, this leads us to timing the market to some degree. And typically the best months for being in the market are October, November, December, January, March, and April. If you put February in there, you got 7 in a row. But the absolute worst months to be invested are typically August and September. It doesn't matter what market you look at, August and September tend to be the worst months to be invested. And so we look at this, and just using a simple timing indicator where we look to see whether the trend is still in our favor, we stay invested if the trend is still in our favor. We get out if the trend's out of favor. This can help with our timing a lot and can expand upon the wins and the losses. And so when we look at this from a simple moving average, convergence divergence indicator, we can see that during the good months, we're actually showing that we make a lot more money. During the bad months, we lose less money because we're out. And just shifting to bonds during the bad months, we can make maybe 4% during the bad months, annualized, and then catch all the upside. Typically catch almost all the upside of the entire year in the good months if you use a simple timing indicator. And so that can be worthwhile looking at. This does not work as well as some of the old school methods because, especially when you consider after taxes, because you have to pay taxes if you sell more than once a year. If you sell after less than 12 months, you have to pay a lot more in taxes. It can work okay inside IRAs, but selling in May and going away has worked since the 1950s. And also consider that during some times of the month are better than other times of the month. Typically, the later part of the months and the early part of the months are better than the middle part of the months because all of the 401k buying is toward the later part of the months and the early part of the months, and then not many people are buying during the rest of the months. And so people can use that to their advantage as well. But let's look at when we can take the biggest advantage of things. The trend is our friend until the trend changes. So we want to catch the trend at the very beginning and hold until the end. And so for that reason, we want to know when the trend's about to run out or when the trends are going to change. We can note when these transition periods are. That's when we make the biggest profits. At a recent Berkshire Hathaway annual meeting, Buffett shared that he learned almost everything he wanted to know about investing from reading The Intelligent Investor and from learning at the feet of Benjamin Graham. In the 8th chapter of The Intelligent Investor, it talks about investing with Mr. Market and taking the advantage of Mr. Market's manic depressive states. So Mr. Market will go through periods where he's manic and he wants to buy everything from you at exorbitant prices, and you take advantage of Mr. Market by selling to him when he's wanting to buy everything. And then Mr. Market will go through periods where he's extremely depressed. He's wanting to sell you everything at super low prices. And so you want to take advantage of Mr. Market when he's super depressed and buy from him at super low prices. And the key is figuring out whether Mr. Market is walking into the office today and he's manic, or he's walking into the office today and he's depressed. The other key is we want to have the right temperament. An investor doesn't need to be super intelligent in order to do really well, just has to have the right temperament and not get overly excited or overly depressed with the market. You want to have the right temperament and take advantage of the periods when the market is overly excited or overly depressed. One thing we want to focus on is the companies. These companies are businesses. We are investing in actual businesses, not pieces of paper, not quotes on the screen. We're investing in the actual businesses. We want to buy great businesses at good prices or good businesses at great prices. Early on in his career, Buffett would buy good businesses at great prices, and he would hopefully own it for a little while, and then he'd sell it while he still could. He considered that a cigar butt philosophy because he was getting the last puff out of the cigar and be able to profit from it and get out. These days, he buys great businesses at good prices, and he holds for a long, long period of time. I would consider buying great business at good prices a much better way to invest, especially from a tax standpoint. One other thing we want to take advantage of is volatility. Volatility is a strategic tool. We look at what's called the VIX index. We can buy things when they're really cheap and the VIX is really high, and typically we're going to make a lot of money when we're buying when the VIX is really high. We can also look at buying when the VIX is low. Usually you don't make as much when the VIX is low. The VIX can stay low for a while, but usually the opportunity for profit is not near as high when the volatility is low. We want to take advantage of things when the volatility is high. We also want to look to sentiment, and this is investor sentiment. So when investor sentiment is really bullish, that is usually a time when we want to be getting out. Now, when is investor sentiment the most bullish? When there are forced buyers. When there are forced buyers out there, that means that people have sold things short and someone's run up the price and forced them to have to buy back shares at a higher price. That's when we know that sentiment is the highest it's going to be, and it's probably time to be taking profits and moving more to cash. Also, we can look at an investor's intelligence and see that bulls exceed bears by a lot. That's another way to look at sentiment, to see that people are extremely bullish or extremely optimistic. Mr. Market is extremely optimistic. It may be a good time to free up some cash. When Mr. Market gets extremely pessimistic, we can look at sentiment. Investor sentiment will show, and we can look at this on American Association of Individual Investors. We can look at the investor sentiment numbers and see that bears exceed bulls by a wide margin. It usually happens after there's been a sell-off, and it's usually a really good time to buy when investor sentiment is really low. The other thing we like to look at is market breadth. When market breadth is really strong, that means that most things are above their 50-day moving average. That's usually a good time to either stay invested or look at freeing up some cash. When market breadth is really low, that means that lots of things are coming down, and when it gets really, really low and it reaches new lows, that's usually a sign we're close to the bottom and it's time to start picking up. So we can get the most benefit and get the biggest profits from taking advantage of the extremes. Remember, something in motion stays in motion until acted on by an outside force, and these outside forces are extreme volatility, extreme sentiment in one way or another, and market breadth reaching a low or maybe even a high. And then the sixth thing says that we want to consider price versus the value. What is the distinction between price and value? Price is what you pay, value is what you get. So we want to be buying something at a price that's much less than its value. The seventh thing is that we want to adopt a business owner's mindset. We want to think about buying into a company as if we are a business owner, which we are. We own businesses when we buy into stocks of companies. And we want to look at this. We want to look at the cash flow. We want to look at the balance sheets. We want to see what advantages these companies have over other companies. And of course, like Buffett likes to do, he likes to go to the owners of the companies or the CEOs of the companies and ask them, if you could take all your money and only invest in one of your competitors and one other competitor, what would that competitor be and why? And they will share with you where they think they see the biggest opportunities in the market are in their industry. And of course, it may lead you to invest in something else, but it may not be at the best price. So we want to look at where we can get things at the best price in the best companies And that tells us a lot. So we want to be thinking like an owner, investing in the best companies where we can get them at a good price. We also want to look at liquidity works in our favor. It's a double-edged sword. The ability to buy shares easily can be a benefit, can also be a detriment, because it encourages people to make too many decisions and do things too often. Buffett is fond of saying that you should only have 20 holes to be able to punch on a card throughout your lifetime in order to buy, or he likes to think of it as pitches that come across the plate, and you only swing at a pitch that is the best pitch. And so we want to be looking at the very best opportunities and take less swings instead of more swings. He also says that we want to look at the growth of the business over the price growth and just the shares of the company. So if revenues are growing and earnings are growing, that's a great way to be looking at whether the company is going to be something you want to buy. We want to buy at a good price, but also buy into something that's going to be growing over time. And then very lastly, we want to be buying at a great price that's a lot less than what the business is worth. Buy into a growing business at a price that's a lot less than what it's worth. We win in two ways that way, because the business is going to grow even if we buy it at a not so good price. If it's growing, it can be a great thing to own over a long period of time. But if we get it at a great price, we're going to win in two ways. We're going to win as it gets back to what it's really worth. We're also going to win as it grows. If we miss one of these by a little bit, the other one can bail us out. But we want to be buying at a great margin of safety in something that's growing very well. We want to buy it at a great price. We buy a great company at a great price. We win in lots of ways, and things work out for us really well over time. So we're talking old school stuff today. I hope you love the old school stuff. Put your thumbs up if you like this old school talk, and subscribe to the channel so you can catch other things as they come out. Click that notification bell as well. Share with your friends. As always, stay thirsty for knowledge. We can drink the rain all about us. And we'll catch up with you next time.